Hi, my name is Brett Bjorn since July 25th, 2012, and welcome back to the Estate Planning Daily Show. Today I want to talk about gifts. Gifts not in the form of birthday presents, Christmas presents, or Hanukkah presents, but estate planning gifts. And the basic form of gifting is the annual exclusion amount of $13,000. When people have a taxable estate and they want to remove assets, every year to as many people as they'd like, they can gift up to $13,000 a year. If a husband and wife have 4 children, that means that a husband can gift $13,000 to each child, and that adds up to $52,000. If the wife also gifts the same amount, that's $104,000. And when a couple who have a taxable estate remove $100,000 from their estate every year, they save, if the rate's 35%, $35,000 every year. Well, that's the basic form of estate planning gifting, and this is just a matter of transferring cash. More advanced gifting techniques become a little bit more complex because they generally involve real estate or stocks or a limited partnership interest or maybe an LLC interest. And when you gift those type of assets, you have to worry about what your tax basis is. If your tax basis, what you paid for it, is $100,000 and $1 million piece of property, it's the $100,000 tax basis that transfers to the children. In other words, if they get the property from you, or the real estate, or the limited partnership, or the LLC interest, and your cost in that is $100,000 and they sell it, they're going to still be taxed on the $900,000 of gain that's inherent in that property. That's not the case when you die with property. You receive a step up in basis. So there's a brand new tax basis to your children. Whereas with gifts, it's the lower of the fair market value or your cost that transfers to your children. So if the property is worth less than what you paid for it, you're transferring to your children a lower tax basis than you currently have. But generally you make gifts of property that's appreciated. Therefore your tax basis does transfer to your kids. When you're doing estate planning to reduce estate taxes with an estate tax rate of 35%, you need to consider these capital gains effects of gifts when you transfer property to your children, and your basis transfers, and if they sell, they're going to have capital gains. Well, currently the federal and California combined rates for capital gains are 25%. So depending upon what the savings is from estate taxes on the gift versus the capital gains that you've just saddled your children with, those two numbers, different numbers, need to be considered. This is separate and apart from any property tax issue. It's an income tax versus an estate tax issue. It's integrated with a gift tax issue. And as always, you're subject to the California probate code if you reside in California, as I am an attorney. My website's 3destateplanning.com, and I often think it should be 5destateplanning.com. And why I say 5D is, as I mentioned before, you're dealing with income tax, gift tax, estate tax, property tax, and the California probate code. Those 5 different elements are fairly tricky, and the numbers aren't always in the same directions. You can receive savings one way in the form of estate taxes, but you may saddle your heirs with income taxes or a property tax increase. You never know. Each situation is different and needs to be analyzed differently. Anyway, that's enough for today. I'll talk about present interest and future interest tomorrow, which is where the annual exclusion is available. Anyway, thanks. Have a great day.